You think that, I mean, a lot of people are saying, listen, China's new at this. You know, they've been in control, the centrally planned. They control everything from how many kids you can have to whatever. But, you know, they're out of their league here, and maybe they should just step back and let the chips fall where they may.
Well, there is a school of thought that by letting it go down gradually, they were having people sell to get in front of the gradual decline, and that they are going to go and do something decisive and let people know that that's the bottom, because that's the free market bottom. That probably would be the most efficient way to get through this. But as your last speaker just said, there are collateral dislocations that could happen as a result of that. And I think that's why the markets are going down. There's afraid there's going to be a credit event or a black swan event as a result of this volatility and China pulling down the currencies of other countries, and somebody is going to get caught on the wrong side of a trade and not be able to pay their loan, which would freeze up the credit market.
You know, John,
Charles, one thing that China's done that's monumentally stupid is these circuit breakers. When you shut down your stock market and you tell investors they can't sell their stock, it's like closing down a bank and telling investors they can't get the money out of the bank. It causes people to circle around the bank the next morning, and all it does is cause more of a panic. By the way, we have that same policy, as you know, here, Charles, post what was that? Post 1987, we put the circuit breakers in.
Right.
It's stupid. I mean, let the market, you know, find its range, and then it can rise again. But all you're going to see is continued sell-offs as a result of those policies.
John, I want to ask you, John Hilsenrath, about the People's Bank of China, perhaps taking action, lowering their main interest rate, because there's got to be a trade-off. Everyone knows, okay, they're going to remove these circuit breakers. There's already been a run on the markets, a run on their currency. Could that be the one thing they announced tonight that could sort of mitigate all of this?
Well, you know, there are a lot of cross currents at play here. If the PBOC is going to reduce interest rates, and they have been doing that, and they're likely to continue doing it over the course of the year, that puts more downward pressure on the currency, and that's one of the problems that they're having. So, you know, I think there's so much that there's only so much that they could do on that front. I do think that we need to remember when we talk about the currency, this is a country with $3.3 trillion of reserves. Yes, there have been fairly large outflows in the last 6 months, but they have a pretty big arsenal that they could work with to try to manage this currency, and I think that's what you're going to see. This is a government that is very intent on managing economic affairs, and I think they'd be very reluctant to just let things go.
Although, Danielle, here's... go
Charles,
ahead.
yeah. If I could jump in here, look, the Chinese policymakers are intent also on trying to steer this massive economy to being more of a U.S.-type consumption-led economy. Letting the yuan go into a free fall is absolutely against that long-term goal that I think policymakers have. They're trying to control capital markets. And I agree that these circuit breakers have just not performed anywhere near what they might have hoped. But any notion that they're going to let the yuan go into a free fall, I think, is absolutely, it's like screaming fire in a theater.
But Danielle, before one second, guys, I want to follow up on that, though, real quick, Danielle, and then I'll go back to you, John. But aren't they between a rock and a hard place, because they were trying to transition their economy from this export-driven economy to a domestic-driven economy like America? It feels like halfway through something changed, and their knee-jerk reaction is to rely back on exports, and doesn't that mean a cheaper currency?
Well, I think what's changed is the fact that if you look at valuations worldwide, the Chinese stock market, despite the declines that we've seen, is still the most overvalued major stock market in the world. So there's going to be, and in any given moment of any kind of a shock to the economy, there are going to be people running for the exits out of the Chinese stock market. And that actually is something policymakers have also done as well. A rock and a hard place, absolutely, but they've done this to themselves.
John?
You know, I want to make one point about the stock market versus the currency market. I think, Charles, you hit the nail on the head. The stock market is a manipulated market. It is not open to global investment the way other markets are. And frankly, it doesn't touch Chinese consumers as much as things like real estate prices do in China. I think the much bigger story right now is what's happening with the currency. And in that respect, they want it to decrease in value because it became overvalued as the U.S. dollar rose, but they're also intent on managing this. And, you know, the big question and the big lesson we're going to learn is, are $3.3 trillion in reserves enough to manage the currency for the world's second largest economy.
Right.
That is the big issue.
Right.